Honorable experts, my industry colleagues, and ladies and gentlemen, thank you very much. And thank you, the organizer, WPIC, for having me. So I have the privilege to share the stage with wonderful speakers. Today, I'm going to talk about solidifying the resource foundation and use innovation as a driving force to expand our global development. So I'm going to talk about the case example from Jinchuan Group as to how can we pursue a high-quality development trajectory for Jinchuan. So in terms of a global resource like a distribution, so the proven reserve of PGM, if you look at the proven reserve of PGM in the world, 98% is concentrated in South Africa and Russia. And by comparison, even though China is a very important consumer market for PGM, relatively speaking, we're not that well endowed. We are highly dependent on foreign countries, and Jinchuan Group, even given the dependence of China for foreign countries, we are only one of the few or the only China producer has the capability to extract from the primary mines for PGM as well. So I'm going to talk about the resource, technology, innovation challenges, as well as the global presence and our Jinchuan Gold. So first of all, I'm going to talk about the resource. I guess that the resource is our foundation to establish Asia's largest production base for mining-oriented PGM. So proven reserve is about 255 tons, accounting for more than 60% of China's total. So we will find that we have already have the stock of about 129 tons of PGM. So we are in Gansu province. So we have a nickel copper deposit around our mines. So and the deposit we have is the third largest, for example, volcanized or sulfurized nickel copper deposit in the world. So this is different from South Africa in the sense that, so for our deposit, so most of the PGMs are the byproducts or associate for the main minerals. So the main minerals are copper, nickel, and sulfurized minerals. So they are having the symbiosis with the PGM as well. So which means that we cannot directly extract it from the mine. We have to do beneficiation and processing, and also trying to do the refinery in order to recycle the much needed PGMs. Right now, we have already built ourselves into largest Asia PGM mining production base. After more than 6 decades of development, Jinchuan Group has already well positioned ourselves as the largest PGM mining exploration extraction base for its kind in Asia. So we have the annual capacity of 13 tons. So last year, we produced the PGM 13.07 tons, accounting for 20.3% like China. So of which you'll find that the PGM extracted from our own mine is 4.86 tons. Second part is about the science and technology innovation. Our target is to make sure that we want to establish China's most comprehensive PGM extraction and recycling base. We are different from South Africa in terms of, for example, the mines in Russia and South Africa. As I mentioned before, so our PGM is associated to, or as a byproduct of copper and nickel. You'll find that which is making us difficult to recycle them. So you'll find that actually about South Africa, you'll find the palladium content for the primary mine is about 7 grams per ton, and us is 0.2 or 0.4 grams per ton. So you'll find that for Russia, there are 12 grams per ton. So it's very different, making us difficult to extract it from our mines. So now you'll find that we have our electronic controlled chlorization and the desulfurization. At the same time, we have the baking type, roasting type of water leaching, soaking, and we can combine that with the chemical extraction to do the deposition as well. That's our technology. So in the past, we mostly deal with a secondary alloy, but now we'll find that the most of the raw materials are tailings. Right, so it's already accounting for 90%. So as a result of that, you will find that which is making us technology intensive in order to do resource extraction and refinery separation, purification, and recycling. We have to do it because of the special nature of the mines we have. So the challenges we are facing is twofold. So I guess first, domestic challenge. Now, for China domestically, as we continuously extract from the mines, I guess that the reserve is declining at the same time, which is making us difficult to further dig under the ground. So because of the limited natural endowment for China, we cannot add our reserve. And then, so actually, we are facing the long-term challenge of ensuring the security of supply from China. At the same time, you'll find that a proven reserve is mostly concentrated in only 2 different places. So there are geopolitical conflict and there are some international trade conflicts as well. So all those things are trying to give us a lot of uncertainty for development and the supply security. So let's talk about the global presence. Our target is very clear. We want to go global to make sure that we are trying to give China supply security by finding resources for PGM all over the world. Now we are trying to have a global presence all over the world as well. So you'll find that actually we are trying to proactively participate in the joint projects. In the 2011, together with China Africa Development Foundation. So we invested in the South Africa project. So this is on the project of which we can do the operation and the co-development of these projects for like the South African projects. You'll find that this is like a backbone, like a platform, so which is South Africa. So you find it's the west wing of the complex. So like a Bushville is the most richest place. It is called the heart center of gravity for the world PGM. So now we are in the process of commissioning and the beneficiation and processing for the first phase of 1 million tons. Before the end of this year, we hope that we can produce something and make the project operational. There are 3 different parts of my presentation. We want to enhance the supply security of our resources, enhance our global operation capability so that we can find the resource allocation all over the world, so that we try to make sure that actually we want to have like the total turnkey solution from extraction, exploration of resources, refinery, deep processing. We want to do it all. So I'd like to have some commercial time for Jinchuan Gold. For your information, so you'll find that this is a fine processing of gold and silver. Our base is in Lanzhou New District, so we can do the recycling, R&D, and the marketing, and we have the whole supply chain. As a result of that, so we really want to set up as a role model for high-end precious metal. So I guess that, so we are in TikTok, Taobao, and JD. So we find that our e-commerce presence is very successful. So the online sales has been promoted very successfully. As a result of that, we can break down the barriers to make sure that we can restructure ourselves. So I'm going to conclude a little bit. So we are at the new departure point for the global energy transition as well as industry transformation. We are ushering in new opportunities for development of our industry. So Jinchuan is trying to develop our mining resources and doing the secondary resource recycling. So these are the 2 wings to have an innovation-oriented, green and open development, so that we want to establish a low-carbon, green and very efficient PGM recycling system to ensure our energy security system, as well as energy usage efficiency to promote the high-quality development of our industry. So like the example we give you, we work in Africa for the Sadibello Platinum. So our partner to join to develop projects. We want to do more projects like that so that we can together build a very safe, reliable, and green sustainable global supply chain for PGM so that we can contribute our bits for the high-quality development of PGM industry in the world. Thank you so much. Thank you, Mr. Xiangbin, for awakening us to the great fact that we also have a high-quality companies here in China as well. So let's welcome the CEO of Tharisa, Phoevos Pouroulis, who has 23 years experience on managing the mining sector in South Africa, very familiar with all the supply chain. So let's welcome Phoevos.
Good morning, and thank you for the opportunity to present here at Shanghai Platinum Week. It really is an honor. So the Tharisa story is one of resource ownership, operational delivery, and purposeful innovation. We have built a platform that supplies the critical minerals the world needs for industrial growth, energy transition, and technological change. Today, I will brief you through who we are, why the metals we mine matter, and how we are positioning Tharisa for sustainable growth. Our three pillars are simple but yet powerful: redefining resources, innovating with purpose, and empowering futures. This is not just a statement, but it's the way we think about how we conduct ourselves and operate our businesses. We own long-life resources. We operate them with discipline. We continue to invest in innovation that allows us to extract more value from the materials we mine. Empowering futures is not just about growth, but to ensure that there are benefits to the people, the communities, and the stakeholders that surround and benefit from investment in these long-life sustainable assets. So if we take a look at Tharisa at a glance, we are an integrated co-producer of platinum group metals and chrome concentrates. We have a clear growth pipeline in our Karo Platinum project, which is under construction. Our flagship Tharisa mine is situated in the heart of the Bushveld complex. It is a significant resource, and we have been operating it for some 16 years. We have 8 years open pit life remaining, thereafter followed by a transition, which we are currently underway, to unlock 60 years of sustainable production from our mechanized board and pillar mining. I think what's unique about Tharisa is our pearl split. You will all be familiar with the UG2 and the Merensky Reef horizons, which historically have been the major source for platinum group metals in the Bushveld complex. Tharisa mines the middle group reef horizons, and you'll see from our composition, we are very rich in rhodium at 10.5%, ruthenium at 16%, iridium at 4.5%, and importantly, almost 53% platinum. We have a footprint that spans the whole value chain, from mining, processing, beneficiation, research and development, and this allows us to engage with our end users. And this has become particularly important in the context of China and our relationships as a major supplier of chrome concentrates into the stainless steel industry. And we've established and forged relationships over 2 decades, which, as we know, are critical for the industrial growth and demand for critical minerals. Our Vision 2030 is very simple. We are growing our business in multiple ways and facets. Our transition to underground is transformational at the Tharisa mine, unlocks multi-decade, multi-generational life and supply of these critical minerals. Our objective in the next 5 years is to bring Karo Platinum to steady state production of over 220,000 PGM ounces. Our beneficiation strategy through Arco Metals to beneficiate the platinum group metals and chrome concentrates that we produce into unique alloys and products. We also have invested heavily in long-duration energy storage through our Redox One battery technology, which uses chrome iron as the electrolyte to store gigawatt-scale energy for baseload energy storage. This is a massive market. This is a $3 trillion addressable market by 2040, and it's a space we believe chrome and iron can play a fundamental role. And then importantly, the way in which we mine is important with ESG and using technology to minimize our impact and the footprint of our mining methodology. A lot of discussion around critical minerals and strategic minerals. And I think South Africa and Zimbabwe are blessed and endowed with a resource wealth that places all 9 of our commodities on the critical minerals list. And this is key and important when one looks at security of supply. And again, just when we look at the value of the Tharisa basket, this is based on a 1 June pricing, you'll see it has the highest value in the Bushveld complex, really driven by those minor metals that we are blessed with. So, with the advent of AI and the discussions that we've witnessed over the last few days, we took the privilege of using AI to generate the following two slides. And when we look at the future uses and demands of PGMs, the future looks bright beyond autocatalysis and the traditional demand drivers that have underpinned PGM demand. And I'm not proposing to go through this in detail, as we spent a lot of time over the last couple of days discussing this. But when we look at the potential coming off the back of a 1 million ounce deficit in 2025, the largest on record, we can see that the revolution of computational power, the build-out of infrastructure, really are critical demand drivers. And then when we add defense spending, potential pledges of 5% of NATO nations, as well as the medical and glass industries from fiberglass to e-glass, we can see a bright future for the demand drivers. But let's not forget chrome. Chrome is a significant and key byproduct, in our case a co-product, and it really is the underpin and the fundamental engine driver for the build-out of a technologically advanced future. Stainless steel is essential. Chrome is what makes stainless steel stainless and is irreplaceable. Much like the PGM concentration, South Africa accounts for 85% of Chinese and Indonesian imports. With a 3.5% compounded annual growth rate, an additional 1.8 million tons of chrome is required on an annual basis just to meet this demand. So when we look at redefining resources, for us, it's about the manner in which we approach our resources, making sure that the energy, effort, and cost that we put into mining, we maximize the economic return from every cube of rock. And this is our philosophy, and it's our operating model. So the Tharisa mine is our flagship operation. We've been mining for 16 years in an open pit manner. The mining right extends over 5,500 hectares, or just short of 5,500 hectares, with a massive resource of some 655 million tons, which unlocks that 60-year-plus underground mining opportunity. But really today, we wanted to touch on Karo Platinum, which is a new and upcoming PGM mine situated on the Great Dyke of Zimbabwe. This is a massive resource, just under 24,000 hectares, 178 million tons, and a reserve of 24.8 million tons, which unlocks the 10 years open pit phase one, where we are targeting 2.6 million tons per annum reef and 226,000 ounces of PGMs. Thereafter, we are planning an underground operation where we'll increase our output to 360,000 ounces. We should also remember that we have significant base metal credits in the Great Dyke of Zimbabwe of copper, nickel, and even some cobalt. Importantly, this is a material creator of new jobs in a country that desperately needs employment with a very low employment rate currently. You'll see our processing plant under construction, flotation section, and the mill section behind that. We are situated in the center chamber of the Great Dyke of Zimbabwe. We take comfort in the fact that major PGM producers have operated successfully and had the lowest cost PGM ounces produced within their portfolios. The prill split differs from the South African MG Reef Horizon and is more akin to the Merensky Reef, with a balanced platinum and palladium, high gold content, and importantly, significant base metals. This is an aerial view of the operating site and the trial open pit mine, and you can see that it's a very compact layout in terms of our infrastructure, and importantly, we have secured and de-risked this project substantially through exploration, some 60 kilometers of exploration outlining the open pit and the underground potential, as well as mining design and a mining contractor having been deployed and mobilized and commenced with pre-stripping. Major infrastructure work has been completed, earthworks, civils, and we are on track to complete our construction by the second half of 2027, at which case we'll be producing our first concentrates. You can see our open pit mining contractor removing strip waste, preparing the benches for our reef extraction. So with that, we really do believe that we're unlocking world-class value with a Tier 1 asset, which requires responsible approach and disciplined, measured development of this resource. When we look at these resources, we plan for the future. We make sure that our approach is disciplined and it allows us to access future longevity through this multi-generational assets. But before I close, I'd like to end with 3 comments. First of all, we believe in the long-term demand outlook for PGMs and chrome concentrates remain compelling in terms of the industrial growth, advanced manufacturing, energy transition, and the technological developments that we've all witnessed. Secondly, I believe Tharisa is a differentiated platform with producing assets, growth projects, beneficiation initiatives, and technological advantages through our R&D initiatives. And thirdly, China remains a very important partner for our industry and for Tharisa. We value the relationships we've forged over the years, and we look forward to strengthening our relationships through our growth in PGM and chrome concentrates. Thank you for your time.
感谢 Phoevos 从重塑资源的宏观视角出发，赋能未来。接下来
Thank you very much. Thank you for giving us this macro perspective on reef defining resources. Our next speaker is Heinrich Muller, who is a seasoned expert with extensive experience from Latin America to Africa, with operating experience managing large-scale mines. The floor is yours.
Good morning, everybody. My name is Heinrich Muller. I'm the Vice President Technical for Bravo Mining. We're a Canadian-listed company developing what we believe to be the next significant source, open-pittable source of PGMs globally. I'd like to start by just extending a word of thanks to the WPIC for what we consider probably the preeminent PGM conference globally. We are grateful to be members of the WPIC, and we extend a word of thanks to Trevor and the entire team that's behind Trevor in organizing the conference. So congratulations to the WPIC, and thank you very much for hosting us. I will be making some forward-looking statements, so please be aware of that. Bravo Mining, like I said, is a Canadian-listed company. We have a current market capitalization of approximately $450 to $500 million. We have approximately $95 million in cash. We are developing the Luanga PGM project, which is located in the north of Brazil, and specifically in the southern area of the state of Pará. We are within the Carajás mining district, the Carajás mining district being the most significant production area within Brazil. It's responsible for 60% of mining-based revenues within Brazil. It is the infrastructure hub of the north of Brazil. We have access to world-class infrastructure that was developed by both the government of Brazil as well as the largest operators in the area, and particularly Vale. It is an area of the world that is extremely well endowed. It hosts 11 of the largest mines in the world, including copper, iron ore, and manganese, as well as gold deposits. Because of the access to infrastructure, the project is well positioned in terms of its expected capital expenditure to develop the asset. We have asphalt road onto our property already established. We have contractual access to the railway line that serves the Carajás region, It's a railway line that has annual capacity of 300 million tons, of which 200 million tons are currently under utilization. That will provide us the opportunity to evacuate either our concentrates or our matte or alloy product to the global markets. We also have access to hydropower adjacent to our site, which comes at, from a world-class perspective, a very low cost, 4 US cents per kilowatt hour. We are also importantly based within the Sudami tax regime area, which is a special tax zone within the north of Brazil that affords us a 75% reduction on our income tax for the first 10 years of operation and affords us the opportunity to, after that period, to then again to apply for a further 10-year extension. The net impact of that 75% reduction in income tax is a reduction of approximately 40% or 30% from a general corporate tax rate between 25 to 30% down to approximately 15%. So very significant. The Carajás region obviously hosts, like I said, some of the largest mines in the world, and it is a very deep and extensive labor pool from a technical perspective for the mining industry. About 95% of our current employees and contractors are locally based. Importantly, we've also been awarded a free trade zone by the government of Brazil, and that will afford us the opportunity to vertically integrate the project. The free trade zone, in addition to the Sudam tax regime, will afford us additional fiscal benefits. So moving on to the resource, we currently have 15 million ounces on a palladium equivalent basis and approximately 300,000 tons of contained nickel. The palladium equivalent number includes platinum, palladium, rhodium, and gold. Approximately 160,000 meters of drilling has been conducted on the project, and we have recently completed a PEA, and currently the project is being advanced through PFS study work. It's important to note that the currently declared resource only extends down to an approximate depth of 250 meters. However, we have conducted drilling down to approximately 550 meters and have demonstrated the continuity of the ore body as it goes down dip. You may have noticed that earlier this week, we have announced to the market some of the first results of the expansion drilling, excuse me, the expansion drilling around the resource that's currently underway on site. And I'm pleased to announce that the drill holes that we have announced or released to the market, extending down 350, 400 meters, have returned results in the order of 50 meters at approximately 4.5 grams per ton platinum and palladium, including an intersection of approximately 25 meters at 5.5 to 6 grams per ton. That demonstrates to us the robustness of the resource, its growth potential, and its continuity down dip. If you pay careful attention to the image on the left-hand side, which shows the resource by its classification as well as the resource constraining pit, you will notice that the deeper parts of the pit extend to the limit of the geological model, which means that the currently defined resource is not limited by the economics of the deposit, it is limited by the amount of drilling data, which means that as we drill deeper and extend the geological model of the deposit, we anticipate that the pit constraint resource will continue to grow. Currently this year we are conducting 35,000 meters of additional drilling, and there's two focuses for that drilling program. Firstly, to migrate some of the inferred into the measured and indicated category, which will support the DFS, which we will conduct next year. The other aspect of the drilling program that we're currently doing now, as I mentioned, is expansion drilling, both laterally as well as down dip. And our target growth is to take the current resource from 15 million ounces to somewhere between 18 to 20 million ounces. As I mentioned, towards the middle of last year, we published our first project study. It was a scoping level study. It contemplated a 17-year life of mine based on the current resource. We anticipate to update that resource post the completion of the drilling program that's currently underway. The project demonstrated that the Luanga deposit has the potential to host a long-life, large, open-pit operation that will produce in the order of 450 to 500,000 ounces of PGMs annually. We anticipate with some of the benefits that we're seeing from the current metallurgical test work that's ongoing, that there is potential that at the same production rate from an ore tons perspective, which is approximately 10 million tons per year, we anticipate that that number could grow to somewhere between 550 and 650,000 ounces per year. We contemplated two scenarios in the scoping study, one being the base case, which was a concentrate sales scenario. That would be conventional flotation of the run-of-mine product, producing a bulk 80 gram to 100 gram per ton and 4 to 5% nickel concentrate, which will then be exported. There are two options for the export, as I mentioned, either by road to our nearest port, which is approximately 500 kilometers away, or by rail, by which we already have contractual access. The highlights in terms of the economic results of that study for the base case at an investment of approximately $500 million for the base case, it returns a NPV at an 8% discount rate of approximately $1.3 billion US, with an all-in sustaining cost of approximately $640 per ounce. The payback period of that is approximately 2.5 years. Similar in terms of the IRR for both the base case and the vertically integrated scenario, approximately 50%. To vertically integrate the project, we'll require to spend approximately $700 million, which will generate an NPV of approximately $1.9 billion US, again for an internal rate of return of approximately 50%. The pricing assumption for this study was a basket price of approximately $15.55 per ounce, and that is approximately 15% below where the current spot price is today. You can see on the bottom of the left-hand side, the bottom left-hand side of the slide, you can see the prill split, or the deportment of the different precious metals and nickel that we produce, so approximately 260,000 ounces of palladium, 160,000 ounces of platinum, 15,000 ounces of rhodium, approximately 8,500 ounces of gold, and 8,500 tons of nickel annually. The CapEx and the development strategy for the asset benefits from our access to infrastructure, which includes, like I said, access to power, access to road, access to water already on site or adjacent to site. We have the benefit of the project, despite the fact that we're located in the southern Amazonian region, we have no native forests on the property approximately 10,000 hectares. We also have no local communities within approximately a 50-kilometer radius. The ground, the property has been heavily disturbed and farmed over the last 50 years. And importantly, as of March last year, we've received the most critical license, which is called the preliminary mining license in Brazil. That is the component of licensing which requires environmental authorization as well as public participation from both a broader society level, but also from the government, the various spheres of government, both local government, state level government, as well as federal government. The next stage in terms of de-risking the project for us would be the completion of the current PFS, and concurrently with that, we intend to submit this quarter the application for the construction license. We anticipate to receive the construction license over the course of the next 6 to 12 months, so by first quarter next year, we should receive the construction license. I'll close with just a little bit more details around the access to the free trade zone, which will allow us to vertically integrate the project. The free trade zone is not critical to our strategy in terms of vertical integration. We could, according to the base case study that we did in the scoping level study, we could vertically integrate the project on site as well, but as a sign of support, the Brazilian government has essentially provided us with a free trade zone. It's very unique in Brazil. It's something that the industry here in China would be very familiar with. There are only 3 free trade zones within Brazil. This is the last and final one that the Brazilian government has authorized, and we are the only mining company, a primary producer of any commodity that has been awarded free trade zone. Why this is significant, and this is something that we are still quantifying and will form part of the economic evaluation of the PFS, is the significant tax benefits. 0 tax on imports, 0 tax on exports, tax holidays on social contribution taxes for up to 10 years, and a host of other tax relief over the period of the operations of the facility that we intend to build there, which will be a conventional smelting facility producing a PGM-rich nickel, matte, or alloy. We also have direct access to the port of Vila do Conde. The project is, or the smelter site is located immediately adjacent to the port of Vila do Conde, which is one of the most significant import and export ports within Brazil. Importantly, and lastly, one of our products will be sulfuric acid. We anticipate that we'll produce somewhere between 120 and 150,000 tons of sulfuric acid annually. Now, in many parts of the world, that is a problem. However, in Brazil, that is a meaningful revenue contributor. The sulfuric acid market in Brazil is highly dislocated from the market in the rest of the world. The reason for that is Brazil is the largest crop agricultural economy in the world and has immense fertilizer demand. The challenge for Brazil is that it only produces internally within the country approximately 20 to 30% of the constituents for fertilizers. And most critically, all of the rest has to be imported. And the most important aspect of that is sulfuric acid, along with phosphate rock. That's why there are 7 fertilizer producers that are our neighbors at the free trade zone at the port of Vila do Conde, all importing phosphate rock and fertilizer and sulfuric acid to be able to produce fertilizers. To give you an idea of the level of dislocation in terms of sulfuric acid between Brazil and the rest of the world, if we go back approximately 6 months prior to the Iranian conflict, sulfuric acid generally in most parts of the world, whether it's Europe, Southern Africa, or North America, was trading approximately $30 to $50 per ton at the smelter gate, in a scenario where you did not have to pay somebody to take that off your hands. At the same time, sulfuric acid was trading $400 per ton in the north of Brazil. During the Iranian conflict, sulfuric acid prices globally generally escalated to approximately $300 to $400 per ton outside of Brazil. Currently, sulfuric acid is trading at $1,200 per ton in Brazil. And with that, I thank you very much for your time.
Thank you very much, Heinrich, for letting us understand the mining profile of Bravo Mining from Brazil. Okay, for this part, we are going to have with the Chalice Mining, General Manager Corporate Development, Ben Goldbloom, who has 15 years experiences for project acquisition and exploration. At the same time, a deep dive in the Australian project. Let's welcome Ben.
Thank you for having Chalice at Shanghai Platinum Week. It's the first time we've been at this conference, and we're very impressed with what Trevor and the team have put together. My name's Ben Goldbloom. I look after corporate development at Chalice, and I'm going to talk to you about why Gonville is going to be one of the next most significant mines in the PGM world. That's our disclaimer, which I encourage you to read in your free time. So who is Chalice Mining? We're a single asset developer on the ASX with a market cap of about 500 million. We have a strong institutional following with funds largely from Australia but also in the US, UK and Europe. We trade about 2 million shares a day, so very strong liquidity for a development project. We're well covered by the sell side, and we have $63 million in cash and listed investments and no debt, and that will see us through to a final investment decision in the first half of 2028. What's the headline on Gonville? Well, this is a Tier 1 scale discovery by the Chalice team made in 2020. We had a PFS delivered in December of last year, and that outlined a 23-year mine life. It will produce 220,000 ounces of 3E PGM, 7,000 tonnes of nickel, 8,000 tonnes of copper, and 700 tonnes of cobalt. It has very compelling economics. It has a pre-tax NPV8 of $1.4 billion, an IRR of 23%, and a payback of less than 3 years. And that's all at very long-term conservative base case assumptions. The all-in sustaining cost is $370 an ounce, so that puts us at the bottom of the cost curve. It's located 70 kilometres outside of Perth in a mining-friendly state and country of Western Australia in Australia. The Western Australian State Government has given it strategic project status. The Australian Federal Government has given it major project status. And recently we brought on Mark Cutifani, who was the CEO of Anglo American for nearly 10 years and most recently the chair of Vale Base Metals. And along with his partner Tony O'Neill, they've joined our Strategic Advisory Committee. And Mark is probably one of the biggest and best names in the PGM and base metal world. And alongside Tony, he's built and operated some of the biggest and best open pit mines. They like what they see with Gonville, particularly the leverage that Gonville has to the next uptick in the commodity price cycle. And that's why they've joined the team to help get this project developed. It has a very unique metal mix, 50%, 51% palladium, 22% nickel and 17% copper. If we were to plug in today's spot prices, it would still be about 50% palladium, but copper and nickel would swap over. You know, copper would be probably just over 20%, nickel would just be under 20%. So with 17 million ounces of PGMs in the ground, this is clearly one of the largest undeveloped resources in the Western world. This is the cost curve, and I guess we're at a PGM conference, so it's no secret to anyone here that it's made up of two main clusters. At the bottom end, you have Norilsk in Russia, which benefits from material base metal credits and vertically integrated. On the right side of the curve, you have the South Africans and Zimbabweans, and most of those operations are made up of deep, ageing, unmechanised mines, and they're experiencing material cost escalation per year. Gonville will sit at the margin of these two clusters, much cheaper than the Africans and competitive with Norilsk. With metal coming out of Russia being harder and harder to access in the West and material cost escalation in South Africa, metal out of Western Australia is looking more and more favourable. So with a long life, low cost asset, leverage really is the key feature. At conservative long-term base case assumptions, our NPV is 1.4 and 23% IRR. But if we were having this conversation in January when palladium was north of 2,000 an ounce, we'd have a project that was valued north of $3 billion and an IRR closer to 40%. For every $100 an ounce you add to the palladium spot price, you add $250 million of NPV and $630 million of total free cash flow. This really is Lassonde curve investing. We're currently trading between 0.3 and 0.4 of our NAV, which is a significant discount for a project that has delivered a PFS, has strong government backing, and is working through the permitting process. So we were talking about Gonville's low costs before, and this really illustrates why we're able to achieve it. The brown shape at the top of that diagram is the open pit shell from the PFS, and what is highlighted there is that Gonville is a big bulk open pit mine with a low strip ratio of 1.2, with the mineralisation starting right at surface. So compare Gonville, a brand new open pit mine doing simple bulk open pit mining, and most likely to have autonomous haul trucks that need some time in the future, to what you have with the rest of the sector doing deep, ageing, unmechanised underground mines, an underground mine with highly unionised workforce. Metal coming out of Gonville is going to be a very safe, reliable place to source your metal. And on top of this, once the PFS shell is done, there's still another 8 million ounces in the ground and a lot more copper and nickel. We've drilled down to 1.1 kilometres, and so we think that the PFS is really just the start of Gonville, and that this mine is going to be in operation for generations to come. Now on to the flow sheet. So usually when you think about PGM mining, you think about chromite reef mining. Gonville is not that. It's an ultramafic sulfide deposit with heavily enriched PGMs. It does not have chrome in it, and so doesn't need the high temperature downstream processing that you need with your African operations. It will produce base metal concentrates and a doré bar, which can be sold all around the world. And we see this as a key point of difference between Gonville and the rest of the sector. The flow sheet is simple. It has crushing, grinding, sequential flotation, and then the flotation tails go to a leach circuit and produce a doré bar. The first stage of flotation will produce a copper PGM concentrate. The second stage of flotation will produce a nickel PGM concentrate. And we've sent these concentrate specs to a number of the major smelters around the world, and they've confirmed that they are highly sought after and given us their indicative terms. In the last quarter of this year, we're going to run an 8-week pilot plant, and that will be the final de-risking step for this flow sheet. Permitting is the critical path for Gonville, and we're well on track. The state government of Western Australia has given it strategic project status. The federal government of Australia has given it major project status. Chalice owns the farmland. It's not in the state forest. There's no native title, and there is very minimal visual impact. The WA government is very pro-development, particularly for critical minerals. And 5 of Gonville's 6 metals are all on the Australia's list of critical minerals. This is a project that all levels of government want to go ahead. How are we going to fund it? Well, after the PFS came out in December of last year, we had inbounds from a range of different parties, from the export credit agencies, from metals traders, from off-takers, from royalty cos, streaming cos. They could all see that this project was going ahead, and they want to get involved and help us fund it. Unsurprisingly, we're going to target the lowest cost of capital, and that's going to come from export credit agencies, and we're in contact with all the major ECAs from all the Western countries. Initial advice is that we'll be able to fund the $820 million CapEx bill with 60 to 70% finance from ECAs, and then the balance will be made up from either prepays from off-takers, metals traders, or royalty co, streaming cos. There is a world where Chalice does not need to tap the equity market to fund this project. So where are we? Well, we've drilled out the resource, we own the land, the process flow sheet has been proven, we've identified the infrastructure, and we've delivered the PFS. Where to from here? Well, there's 3 key work streams that we're working on now, all in parallel. That's financing and offtake, that's the bankable feasibility study, and our mining approval. That will take us through to a final investment decision in the first half of 2028, a 2-year build, and we'll be in production in the first half of 2030. So what should you take away from this talk today is that Chalice owns one of the largest undeveloped PGM assets in the Western world. It has compelling financial metrics, it sits at the bottom of the cost curve, and there is strong government support. We're pushing ahead with this project. We'll be FID in 2028 and first production in 2030. Thanks for listening in today. I'll be around at the conference for the rest of the day. If you'd like to learn more, then please come and say hello. Thank you.
Thank you very much, Ben, for giving us this introduction about the new opportunities of the Australian PGM mines. So now we have finished all 4 presentations. We are ready to go into the panel discussion. I will invite to the stage Brian Morgan from RMB Morgan Stanley to the stage to moderate the next panel discussion. Also, I want to invite all the 4 keynote speakers to the stage for the panel discussion.
Right, good morning everybody. It's good to be at Shanghai Platinum Week this year. And we've got 4 gentlemen here who are developing projects, developing their businesses. And I totted it up quickly this morning. Between the 4 of them, they have a production pipeline of projects of about 1.3 million PGM ounces. It's about 10% of global supply, so it's fairly significant. But the industry has not been kind to development projects in the last 20 years. You know, as demand has declined, we've seen no need for new projects, or limited need for new projects, and in actual fact, we've seen limited need for existing supply. So it's bold to be bringing on new supply now. And when you bring in on new supply, you really need to pin down your economics very quickly and very absolutely. And the most important part is funding has to be locked down. So we're going to focus a couple of questions on that this morning. Phoevos, if I can start with you. Can we just chat to us a little bit about how much more is needed to finish Coro? And then also maybe just chat to us a little bit about the ramp-up profile and how you see things going through 2031.
Sure, thank you for the question. So in terms of the balance of funding, we require between $250 and $300 million. We've put into the project since 2018 around $240 million of equity, and we continue to fund through this construction phase on our balance sheet. We are closing out on 2 solutions as we speak right now for that balance of funding, which then sees us into first ore in mill in the second half of 2027, with a ramp up of about 9 months we've given ourselves to get to that steady state throughput. The benefit of having taken a bit longer to develop this project is that we've been running a 1 ton per hour pilot flotation plant, so we've got a very good understanding of the mineralogy, the metallurgy, and the recoveries of the main sulfide zone, and we've been able to optimize the reagent mix. So a lot of the teething problems or tweaking that you would find in a normal rapid deployment or development, we've managed to sort of front load that experience. So we think 9 months is reasonable to get to steady state.
Okay, very good. Heinrich, can I ask the same question to you? Funding for your project.
Yeah, sure. Thanks, Brian. So we've recently completed a fundraise, which again will, we probably won't be required to go back to the market, probably for the foreseeable future, and which probably means foreseeable years. We've managed to raise concurrently at the start of this year through both a private placement and a board deal, approximately $95 million. Importantly, as part of that fundraise came a letter of intent with Orion Mine Finance to the tune of $300 million. So depending on how you cut the scenario and the stage development of the asset, whether it be the base case as we're contemplating it currently in the PA, which is concentrate sales, or the vertical integration, you're looking at a capex number of about $500 to $700 million. So that takes care potentially of about a third of the capex, a little bit more than a third. Last year, we were also shortlisted by the Brazilian Development Bank for state-backed cheap finance. Importantly, the letter of intent from Orion is a right to match. The access that we hope to get in terms of funding from the Brazilian Development Bank will give us a very low cost of capital, and that will need to be matched then on the basis of the letter of intent. So that, we believe, will drive the cost of capital down. Now, we anticipate that the Brazilian Development Bank, they generally write checks for projects of this size in the order of $200 to $250 million. So, that gives us, on the base case, essentially, from a funding perspective, just about covers that cost. And then, the change that we'll need to vertically integrate could come, from a number of other options. It's important to note, though, that $300 million facility, or not facility, but instrument that comes from Orion, there is some flexibility in that also to split out in terms of what specific instrument we'll use to finance, and it could be a blend from Orion specifically, so either 100% debt or a split between debt and royalties or streaming, or a component of equity within that $300 million package. So that's how we see the path forward in terms of financing.
Thank you. Ben, you spoke pretty extensively about funding in your presentation, but anything else you want to add to that?
Mostly that what we're finding is that the ECAs are working together. So with a project like Gonville, which is in Western Australia, critical minerals, it's right in the wheelhouse of the type of project that ECAs want to throw money at. What we're finding is that the Australian ECA, Export Finance Australia, will take the lead. And then what will happen is once Export Finance Australia have taken the lead, US EXIM will fall in behind, the Canadian EDC will fall behind, and then potentially others. So we don't just view it as sort of one ECA that's going to help, it's going to be a syndication of a number of them.
That's cool, thank you. Just changing tack here, Heinrich, I got my associate Claude to build a model of Luanga, and just looking at the results, it was quite stark. Felt a bit like I was looking at Mogalakwena, actually. It's 80 million tons of material moved, just over 2 grams a ton sort of grades. Mogalakwena is 2.6, 2.7. It's a very big operation that you have in mind here, and so you do have an all-in sustaining cost coming out and the feasibility coming out at about $638 an ounce, as you presented now. Mogalakwena is coming in at about 1,000. What's the differences?
I'm always cautious when people compare us with Mogalakwena or the northern limb of the Bushveld, because I think the endowment of the northern limb is it is very unique in terms of not only PGMs but in terms of mineral deposits in general. It's the highest endowment in terms of precious metals and one of the largest nickel deposits in the world, in fact. So, however, there are some similarities to the Platte Reef that characterizes the northern limb, but there are also some key differentiating factors. In terms of the similarities, yes, we've got a very wide and a similar grade profile in terms of the style of mineralization. So you're talking about thicknesses of the reef between 30 and 50, in some cases even thicker. The grade, the resource grade that you quoted is correct. However, in the PEA, you will see that the production grade is slightly higher than that, the early years being above 3 grams per ton over the first 5 to 7 years, and then tailing off to approximately 2.8 grams per ton. So very similar in terms of geometry, in terms of grade. There are, however, some fundamental drivers in terms of both the area where we operate, being based in Brazil, but also in terms of the character of the ore that differentiates it, that really drives down the all-in sustaining cost. Firstly, I would start with the ore hardness. Our ore hardness is approximately 40 to 50% softer than the northern limb, which means that despite the fact that we are grinding finer, our energy consumption will be materially lower than operations on the northern limb. So that's the starting point. That is further compounded by the fact that we have, even when benchmarked globally, we have access to some of the cheapest renewable energy on the project. And that, as I mentioned in the presentation, our bulk energy cost in that region will be in the order of 4 US cents per kilowatt hour, so exceptionally low power costs. and there is plenty of it in the north of Brazil. So we don't have any constraints in terms of either the demand that you would require from the grid or in terms of the cost. The other aspect of the all-in sustaining cost, at least so far as the sustaining capital component of that, calculation attributes, is the fact that we have essentially, we are surrounded by large mines, and we have very well established infrastructure basically onto our property. And that drives the overall capex profile down, but also the sustaining capex that impacts on that number. So those are the fundamental things. I think importantly for us, coming from a development perspective or a developer or explorer, for us, grade is king. And you're never going to get away from having having either low grade or high grade in terms of how it impacts on the economics of the project, because that then goes through all the way through to your processing circuit, your recoveries that you can anticipate, which then directly translates into your OPEX.
Very good, thank you. Xiangbin, can I turn to you? I was struck in your presentation, I hadn't realized just how big your recycling business is. Can you chat to us a little bit about that and the future prospects of that business?
Sure, no problem. So I'm talking about the recycling businesses in the future as well. Thank you very much for your question. So glad to learn from so many top mines in the world as well. Talking about the different mining projects along the world for Jinchuan, our company, we have been extracting and exploring our own operated mines for so many years. So I guess that not only we can do the extraction from primary, but at the same time the tailings also contain some PGM we can further extract. But there are some recycling businesses, as I mentioned before. I would like to shed some light on how we have been through in the past. So it's a 100% self-operated PGM containing mines. But now we can couple that with almost half of 50% is coming from the secondary recycling. So that's the percentage split from our portfolio. So we really hope that within the next few years, actually prior to the year 2030, so we really want to make sure that we want to add another 10% more contributed from the recycling to our total business pie. Thank you.
Thank you very much. I think we've got maybe time for one more. Phoevos, can I just ask you, have you secured concentrate offtake for Karo?
Yeah, so you'll be aware we have existing relationships in Tharisa with two of the majors, where we've been supplying concentrate since inception. We are well advanced in concluding our concentrate agreements for the Karo platinum concentrate, which is not insignificant in terms of its volume at 226,000 ounces, and importantly, the base metal content, which potentially poses capacity constraints depending on the ultimate end user. I think what's been interesting for us through this process, through our existing discussions and relationships, is that there are other markets that one hasn't considered in the South African context because of the regulation that requires you to process and beneficiate within the country. We have an exemption in Zimbabwe to export our concentrates, so we're able to look outside of the South African traditional PGM refiners, and in fact we've engaged with two international parties that are very interested in these types of concentrates for varying reasons. Logistics is a constraint, and it is a factor that one has to consider, even though the volumes are small by comparison to the bulks that we move when we look at chrome concentrates, but those are well established transportation and logistics channels. So yeah.
Very good. Cool. Thank you very much, guys. I really appreciate the time this morning. It's good to see some projects in development in the industry, and I wish you all the best.